Okay, good morning, guys. Let me get my model up. Hope you had a good week. We had changed Eastern time in the US, our clocks. So I think maybe some people might have been thrown off by that. We changed them up an hour. So some people might still think it's 7 o'clock, depending on what country you're in. But okay, I'm recording this session. And today we're going to get into the balance sheet, which is, I think, extremely important. And what I want to do is I want to go through, this might take a couple classes. I want to go through an overview of what the balance sheet is. You probably know this, but just to check the box. And then I want to provide ways and techniques to build and balance the balance sheet. And I want to spend a little time on this because I know it's important for a lot of people. I want to let you know what I've developed and is in my books as a foolproof method to make sure a balance sheet is always in balance. And I'm excited to go through that. So we're going to spend this class, next class on most of that. And then we just need to get through that debt schedule and we're done with the model. Then we're going to move on to valuation. So it's a big step. We've gone through a lot. So today, let's dive right into it. Balance sheet is a summary of a company's assets, liabilities, and equity on a given date. So we talked about this a little bit last week when starting to construct the balance sheet. This is a point in time. This is how much you have. What do I have right now? How much inventory is in my warehouse? As opposed to sales, which is a period, right? How much did I make over a year? So it's a different perspective, right? And so the balance sheet is broken up into three major sections: assets, which is what a company owns; liabilities, which is what a company owes, debts, obligations; and equity. And equity can come in several forms. And we know that each of these sections, at least the assets and liabilities, come in current and non-current forms, or some people call it short-term and long-term. Short-term assets, long-term assets, or current assets, non-current assets. Same idea. Current being the items that you own that will become liquidated within 30, 60, or 90 days. That's current, right? Accounts receivable is an example of that. Well, we know accounts receivable, as spoken about in the working capital section, is ideally items that will be converted into cash within the next 30, 60, or 90 days. Inventory is an asset that we expect to be sold within 30, 60, or 90 days. So long-term examples of long-term assets are like our property, plant, and equipment, PP&E. And I'll start talking about this piece now because it's going to become important in our model. Your property, plant, and equipment is the larger assets that you purchase to necessary to facilitate the operations of your business. If it's automobiles, if it's warehouse buildings that have a life of 10, 20, 30, 40 years. And in modeling, there are two items that adjust this property, plant, and equipment value. Depreciation, as we've spoken about in the depreciation schedule, reduces that value. It's accounting for the wearing down, the aging of these assets. And we also have capital expenditures, which we've kind of glossed over, although it was a starting point for our depreciation schedule. Capital expenditures is the future improvement of our property, plant, and equipment. Capital expenditures are the money spent to either refurbish or improve or buy more property. So when you think about property, plant, and equipment, it increases by CapEx spend. The more CapEx we spend, the bigger the value gets, and it reduces by our depreciation. So we'll talk a little bit more about that, or we'll actually model that out. And then there's another example, goodwill, which we glossed over, but goodwill we talk about more completely in the mergers and acquisitions course, which is quite literally, it's when you're buying a business, and a business always has a book value. The monies paid above that book value gets accounted for in goodwill. So let's take a quick example of, let's say, an automobile. Although from an accounting perspective, this isn't completely accurate, but I think it's a good picture. Let's say you want to buy a used car, your neighbor has a used car, and you tell him, you look up in the books, in the blue book, which is the book that shows the value of all of cars. In the blue book, the value of the car is $2,500. Well, you pay him $3,000. I don't know, maybe a couple people are interested in the car. You want to pay a little bit more to make sure that you get the car and not the other person gets the car, right? And so you're paying $3,000. So from an accounting perspective, the value of the car is $2,500. Why'd you pay $3,000? Why'd you pay $500 more? Now you know why, because there's other people bidding on the car and things like that. But from an accounting perspective, you can't record the value of the car at $3,000. You got to record it at $2,500 because that's the value of the car. That difference is goodwill. Now, I don't want to get too deep down this kind of rabbit hole here, because when acquiring an asset like a car, I think somebody might listen to me and say, well, when you're acquiring an asset like a car, this might not be the best example, because when you're acquiring an asset like a car, it is true, the price paid becomes the new asset value. If I were to pay $3,000, then it does go on my books at $3,000 because it's an asset. But in a business, it's a little bit more complicated than that. In a business, when you are acquiring a balance sheet of assets and inventory and employees, right? There's a book value of a business, and then there's a price paid of a business that's greater than the book value. And you cannot just, in many cases, record the price paid as the book value of the business. So that difference in a business, there are auctions, there are bidding processes. And so all I'm trying to illustrate is the difference between the book value and the price paid. This is a quote unquote unknown reason from an accounting perspective of why you'd pay for a business more than what it's worth on the books. That becomes goodwill. Anyway, I don't want to get too deep down that. Those are assets. Liabilities, debts and obligations. Again, there are current and non-current liabilities. Example of a current liability, short-term debt, accounts payable. Spoke about accounts payable and accrued liabilities when thinking about working capital. Non-current, real easy, long-term debt. Deferred taxes are long-term. When you defer taxes, we talked about using the methods of depreciation to defer your taxes. You're not going to pay that back in 30 days. What's the point? You want to defer those taxes for quite a while. And then shareholders equity. Now, shareholders equity, I think about in three major sections, although oftentimes, and you could probably see in the Amazon report, oftentimes there's a little bit more to it, but they all generally fall into, well, there's more subsections, but they're all fall into generally these three major segments. Shareholders equity, right? Stock, your equity investors, which could be common or preferred. Retained earnings, I want to talk about that right now. So retained earnings is the net income that's been produced in your business that has not been distributed. So the way the whole model flow kind of links together is when you have net income in your business, the net income bottom line in your business flows into your retained earnings. It's the earnings that's been generated in your business that improves value in your business. But it's the retained earnings after you've paid your dividends, because you've likely paid your distributors. You've likely paid your shareholders if you are a dividend paying business. And so your retained earnings is the net income after your dividends. And then you have treasury stock. Treasury stock is the stock that's been bought back by the business. We talked a little bit about in the last class the concept of, we talk about this more in the beginning of an M&A, how buying back stock is a strategy for improving value. So these are the three major sections of shareholders equity. And notice I have put at the top of this slide and 4 slides back, formulas, balance sheet formulas that keep the balance sheet in order. Your assets minus your liabilities, or your net assets, must always match the shareholders' equity. This is the balance sheet balancing formula. This is the tricky, that a lot of analysts get hung up on, is how do I make sure my balance sheet balances? Because what we're going to do is we're going to build each individual line item line by line and project them forward. And we have to do it in such a way that this formula holds. Simple algebra shows this formula in another way. You can move this liabilities to the right side of the equation, switch from minus to plus, and say you can look at this also as assets equals liabilities plus shareholders' equity. It's another way to look at it. And assets, okay, well, here's assets minus liabilities equals shareholders' equity. I thought this formula was the formula written the other way, but you can also say assets equals liabilities plus shareholders' equity. Okay, so that's the basics of the balance sheet. And your kind of homework was to lay out this whole section. And if you see, when building this, it's the balance sheet, unlike the income statement. The income statement was the most really complicated in that there are several ways an income statement can be laid out, and we as analysts have to decipher how a company is laid out its income statement and have to kind of bucket it so that we can get EBITDA to come through and have it in sections so that we can use it for analysis. The cash on the balance sheet are a lot more straightforward. And here we have our current assets. They have cash, marketable securities, which are, just as it's explained, securities and investments that can be liquidated at any time. We have the working capital items, inventory, accounts receivable. I left this line item in here. I probably could have deleted it. This is from the template of the current assets. Then we have long-term assets, property, plant, and equipment, operating leases, which is something new. You know about leases on a car. This isn't a lease to own. This is an operating lease. This is the rights to operate. I believe these are warehouses. They have quite a bit of goodwill, so they must have made some acquisitions in the past. And then a bucket of other long-term assets, hodgepodge of a bunch of different assets. So, but generally, asset section, current, non-current. Liabilities, same idea. Accounts payable, accrued expenses, unearned revenue. We discussed these in working capital. Short-term debts was in the template. I was very surprised that the company did not have short-term debts. I've almost never seen a company with long-term debt and no short-term debt. I thought that was very unusual. And actually, in the 2020 reports, they do end up having short-term debt. But again, I'm not going to complicate things. I will go through these courses again and rebuild the model of 2020 after we're done with this. Short-term debt. Long-term liabilities, they have three. They have long-term debts. They have long-term leases, which are like debts. The leases to own, ownership leases on properties, and then other long-term liabilities, which I believe are almost like leases. We're going to dig into this a little bit more when we get to the debt schedule. And then shareholders' equity. Preferred stock, they have none. Common stock, we talked about how they have a par value of common stock of 5 and an additional paid-in capital of 26791. We've talked about how we want to consolidate the par value and the additional paid-in capital for modeling purposes. That's one of the few consolidations that we go through. Then we have treasury stock. This is repurchase stock. And then we have retained earnings and accumulated other comprehensive loss. Now, we didn't talk about this in the slide, but this is very important. I see in almost every company now. This is very similar to retained earnings. Retained earnings is the net income in the business that flows into here. Accumulated other comprehensive income or loss. These are, if you remember, in our 10K, we have an income statement. Where is our income statement? Statement of operations. It gives us net income. Net income flows into shareholders' equity. And then we have this substatement, the statement of other comprehensive income. Look what's in there. Foreign currency translation adjustments, transaction adjustments. Remember, we have a line item like that in the bottom of our cash flow statement. Right, at the bottom of our cash flow statement, we have foreign currency adjustments, right? gains and losses on sales. These line items, which are in a lot of the eyes of a lot of companies, impacting your operations, but aren't admissible under a proper income statement. They get laid out in the statement of other comprehensive income. These line items will flow into our balance sheet under the section other comprehensive income right here. And I'll show you how that flows. But basically, if you see line items that are like this in the cash flow statement, we will link those. They will flow into the other comprehensive income. So it'll make more sense when I talk about how this gets modeled. We're going to talk about that right now. Right now, our model is going to be built in such a way that the cash flow drives the balance sheet. Why is that important? Because models can be built in two different ways. You can build an income statement and a balance sheet and then back into the cash flow statement, or you can build an income statement and a cash flow statement and then have the cash flow drive the balance sheet. So I am using the cash flow drives the balance sheet method because it's more common, and I believe it's a lot more accurate and it's more logical. Cash flow drives the balance sheet. And let me explain that a little bit more. But it is more logical, first of all, to have, as we discussed, a statement of income. And then after building your income statement, saying, okay, well, I've produced $20,000 in earnings. How much of that is actually cash? In order to answer that question, you will build the cash flow statement. And we will use the cash flow statement to project the balance sheet. That's the way a lot of these models are built. The other way is if you have an income statement, you have a balance sheet, and then you have to solve for a cash flow statement. So, for example, in private equity, a lot of times, you are dealing with companies that might not even have a cash flow statement. So your task is to build your own cash flow statement. Why is that the case? Well, if anybody has a company or started a little company before, if you know about filing taxes for the IRS, you are required to produce a statement of income and a statement of balances. You're not required to produce a cash flow statement. So sometimes a lot of companies don't have cash flow statements. And that's where the origins of, and commonly in private equity, you have a company that you're looking to acquire will give you an income statement and a balance sheet. And it's up to you to create your own cash flow statement. So I've seen models where you have an income statement, a balance sheet, and then you're backing into the cash flow statement. The reason why I don't think that's accurate if you have a choice is because you are solving for an unknown. If you have a balance sheet and are subtracting the two, you're solving for an unknown. And what that means is you could be making up line items that may or may not exist. The other way, if you have an income statement and a cash flow statement and use the cash flow to drive the balance sheet, remember the cash flow statement is probably one of the most accurate statements you will get because each line item that's reported, especially if it's reported and audited, will measure actual cash flows. If you use those cash flows to drive the balance sheet, you're taking every single cash line item and asking yourself, how does this cash flow impact an asset, a liability, or a shareholder's equity? It is a lot more accurate. So if you have a choice, it is a lot more accurate to use the method of having the cash flow drive the balance sheet. And that's why in a big company where you have all three statements and you have a choice, I'm going to go with the cash flow drives the balance sheet method. And if anybody has questions, I could talk more about this in the next class, but I want to get into some theory and how to balance the balance sheet. Okay, so The cash flow drive the balance sheet method takes each and every cash flow and asks the question, how does this cash flow drive an asset liability or shareholders equity, and which line item does it impact? So, for example, let's just dig right into it. Oops, that's my solution. For example, cash and cash equivalents. Okay. Which cash flow statement line item drives this cash flow statement, this balance sheet line item? This is a little bit trivial and easy. Cash, the total change in cash, will impact our balance of cash. Quite literally, if Amazon at the end of 2020 has generated $42 billion, then that will increase your cash balance by $42 billion, 36 billion plus 42. Very simply. So we had $36 billion. They made 42 billion more. So they're going to have 36 plus 42. So my 2020 balance sheet is going to be equal to my 2019 plus all the money I made in 2020. Now I know this is a big jump, but this number will drop a little bit once we put in these debt numbers. Trust me. It's that simple. We used the cash flow statement to drive the balance sheet. Okay. Marketable securities. So what I'm going to do is to make sure that I've not used a cash flow statement line item twice, or that I've not left out a cash flow statement line item, I'm going to mark them off as I go, because the way a balance sheet stays in balance is by making sure you have utilized each and every cash flow statement line item once and only one time. So I'm going to mark them off as I go. Now, I see here, marketable securities. Is there any line item here that resembles marketable securities? I see right here, investments and proceeds in marketable securities. There we go. Now, before we get to marketable securities, I want to illustrate a concept that I think is easier to understand when thinking about an object like inventory. So let's jump to inventory. Let's do inventory, and then I want to go back to marketable securities because I think the concept is easier to understand here. So let's look at inventory. Inventory is a working capital line item. We've modeled this in the working capital schedule, but do not go to the working capital schedule for this. Remember, the way this works is it has to come from the cash flow statement. Trust me, if you start pulling things from other schedules, you're going to start to lose the general theory, and you're going to start to make mistakes, and you're going to end up having an unbalanced balance sheet. It's got to come from the cash flow statement. Inventory comes from inventory in the working capital section of the cash flow statement. So we know that this will drive the balance sheet inventory. Now, the question is, in which way? So if I were to have spent $5,000 in inventory, $1 billion, sorry, minus 5 billion, would my inventory go up or down? My inventory is going to go up. I've purchased inventory. I've built inventory. So my 20 billion is going to go up by 5 billion, not down. So I'm going to take, for 2020 balance sheet, inventory minus that 5 billion, because minus -5, double negative, is going to turn into a positive. My balance is going to go up. Okay. Let's look at marketable securities now. Similar idea. Let me mark this off. If I have generated $1 billion in marketable securities, I made money, I must have sold securities. So my security value is going to go down. I have less securities on my balance sheet because I sold them away. So balance sheet item here is going to be equal to my starting balance minus the 1 billion. It's going to go down by $1 billion. I sold them. I bought, balance went up. Look at the pattern and formula here. The value equals the item from the year before, right? Item from the year before, F, plus or minus the cash flow change. Very simple. And notice what you've seen here, and will be an ongoing pattern for the assets. It's a minus. The only exception is cash. So again, very fundamentally, the formula for building a balance sheet is always equals to the year before plus or minus that cash flow change. For every single asset, it's always a minus, except for cash. Why is it always a minus? Because the relationship between cash and an asset is inverted. Think about inventory. If you spend money, your asset goes up. If you want to sell an asset goes away, your money goes up. It's an inverse relationship, always for every asset. The one exception is cash, because cash builds cash. So again, having a simple structure and formula and sticking to the process of each and every cash flow statement line item drives the balance sheet will ensure, guarantee you will have a model that you can easily build and balance. Let's continue. Accounts receivable. Ooh, oops. Accounts receivable. How'd that happen? Equal to the year before minus accounts receivable. Change in accounts receivable. Same formula. Real simple. I'm going to mark this off. Other current assets. I just had that from the template. Let's copy the formula over. Let's go to property, plant, and equipment. As we mentioned in the slides, where are our slides? Property, plant, and equipment is driven from at least these two line items: capital expenditures and depreciation. So property, plant, and equipment is going to equal to balance from the year before and the two line items, capital expenditures and depreciation. Always a minus. Think about it. The minus even works here. Why? Depreciation reduces your PP&E value. So having your property, plant, and equipment from the year before minus depreciation, minus 27 billion, will reduce your assets by 27 billion. CapEx increases your assets by 27 billion. So having CapEx of negative 22 minus negative 22 minus the negative is going to increase by 22 billion. Minus, always a minus. Okay. I'm going to mark off these line items since I use them already. CapEx. Depreciation. Next, operating leases. Now, I don't know. Do I see anything with operating leases? Operating expense. I don't see anything about operating leases yet. These are finance leases, a little bit different. So what I'm going to do is I'm not going to leave it out. If you don't see a cash flow statement line item that impacts a balance sheet line item, don't make it zero. I don't know why a lot of people do it. It doesn't go away. It just stays the same. It remains unchanged for now. I don't see anything that would impact that. Equal to the year before. Okay. Goodwill. Same thing. I don't see in here anything related to goodwill yet. So I'm going to keep this flat. Other long-term assets. Now, other line items, what I like to do for these, other could be anything. It could be a catch-all for a few cash flow statement line items that we really don't know where they're supposed to go. So a lot of these other this, other that, I'm going to keep it flat for now. And this is where marking off each cash flow statement line item becomes so important. I'm going to go through and attach the cash flow statement line items that are big and obvious to me. Then I'm going to go back and see, all right, which line items did I not mark off? And let me try to dig deeper and figure out where they should go. So I'm going to keep this flat, knowing maybe I'll have to come back and use this line item. Let's go to liabilities. Okay, accounts payable. Accounts payable, remember, we had built in the working capital section. And think of accounts payable as like a debt or obligation. So if I've generated $10 billion in payables, if I've generated $10 billion in expenses that I owe to somebody, my liability goes up, doesn't go down. Now think about debt. If I were to raise debt, if my balance of debt goes up, right? If I were to borrow $10 billion, I get money. I also get an obligation. Cash goes up, debt goes up. Not like the asset. Asset is cash goes up, debt asset goes down. Here, cash goes up, liability goes up. So in this case, in liabilities, accounts payable is going to be equal to the year before plus, not minus, plus the accounts payable. This is a direct relationship, not indirect, not minus, not cash up, asset down. This is cash up, liability up. So for every liability, the formula is going to be plus. It's going to be equal to the year before plus the cash statement line item. Let's try for accrued expenses. Equals to the line item from the year before plus cash flow statement accrued expenses. Unearned revenue, same idea. Equals to the year before plus unearned revenue. Let me mark these three line items down that I've used every single working capital line item. Much easier now. Short-term debt was from the template. I'm going to copy that. Okay. Long-term liabilities. Now, long-term lease liabilities. I see a line item down here for finance leases. Even though we didn't link this up yet, this is going to come from our debt schedule. I want to pull cash flow into the balance sheet. So once this becomes populated, it's all going to continue to flow. Okay, so long-term lease is going to be equal to long-term leases from the year before plus cash flow statement, finance leases. And I'm sorry, okay? There's a short-term debt line item there too. So I'm sorry. I'm going to go equals to the year before plus, even though it's zero and a little bit trivial, just for the template, plus this short-term debt line item here. I didn't see that. That's my mistake. Got to link it all through. I don't know why this is bold. Okay. So long-term debt equals long-term debt from the year before plus long-term debt borrowings. Okay. Other long-term liabilities. Anything other. I'm going to wait until I'm done and I'm going to see, are there any line items left over? Let's analyze that in a little bit. But for now, we've linked up short-term debt, long-term debt, finance leases. Okay. Copy that formula. Now we're down to preferred stock. Wow. Getting through this quicker. A lot easier, huh? Equity, preferred stock. Is there anything here for preferred stock? Yes, there's an issuance of preferred stock. How do you think about shareholders' equity in terms of pluses or minuses? Well, if we were to raise equity, okay, we would get money. We were to raise equity. If an investor were to invest in us, we would get money, and we would have to represent that investor's investment in your shareholders' equity. So your money would go up, and the equity would go up. So shareholders' equity acts and moves just like liabilities. Equity up, cash up. Equity down, cash down. So it's going to be plus. So preferred stock is going to be equal to the year before plus issuance of preferred stock. Common stock, stock from the year before plus issuance of common stock. Same idea. Repurchase of stock from the year before plus repurchase of stock. Okay. Now, let me mark off that I've done 1, 2, 3. Okay. Accumulated other comprehensive income loss. This is, again, one of those, I call it catch-all line items. Catch-all meaning there could be a bunch of little loose cash flow statement line items that we have to think about. All right, where does this go? Does it go into other assets? Does it go into other liabilities or accumulated other comprehensive income? So what I'm going to do is I'm going to leave this flat for now, and I'm going to go to retained earnings. Retained earnings is always net income and dividends, maybe some other things too. So I'm going to go equals retained earnings plus cash flow statement, net income all the way at the top, plus, where are the dividends? Okay, dividends here, which are 0, plus, plus. Okay, let me mark off net income here. Let me mark off dividends here. Okay. Copy the formulas to the right. And we don't balance yet. Right? The balancing would balance if this number would equal this number. We're off by quite a lot. We must have missed some pretty big pieces, right? This is saying your assets should equal the sum of your liabilities and your equity. Okay, so I want to talk about balancing a balance sheet. Let me see how much time I have here. I'm going to keep going until it gives me a warning. Interesting. So why are we not balancing? Well, remember what I mentioned about marking everything off. What are there any items here that I haven't marked off yet? Oh yeah, stock-based compensation, other expense, income tax, deferred taxes, foreign currency exchanges. There's a lot of line items I haven't linked up here. Okay. So this is the way I like to build the balance sheet. I like to first link up all the major items that I know about, and then look at all these little line items and say, all right, well, where else could they go? Okay, so let's look at what we didn't link up. Stock-based compensation. Okay, this is an operating item. So stock-based compensation, sometimes what you could do is you can kind of Google, stock-based compensation journal entries or how it impacts the balance sheet. And stock-based compensation is employee stock options that have been granted. And this will actually, if you look it up, this will actually impact your common stock. These are vested stock options. And when an employee exercises their stock options, it'll impact your value of common stock. So this will be linked into your common stock additional paid in capital. Right now we have common stock equal to the year before plus issuance of common stock. We're going to also add it to your stock-based compensation. Okay, that helps. That gets us closer. Mark to that off. Okay. Now we have these two other, very similar, other expense line items, other expense assets or liabilities. Okay. Now these are long-term, these are long-term, these are long-term expense adjustments. They're not short-term. If they'd be short-term, they'd likely be in working capital, right? So what I would think about putting them in is these would either be an other asset, okay, an other liability, or accumulated other comprehensive income. So at this point, when you see a lot of loose, I call them loose lingering line items. These aren't major, these aren't CapEx, depreciation, things that go into major categories. There's usually 3 areas you can put them in, and oftentimes it's a bit debatable. It's a bit of an unknown. And you know what? These often are smaller line items, and it often might not matter so much in terms of your overall model and your overall valuation. But you have to make an educated guess as to whether these line items should be lumped into other assets, other liabilities, or accumulated other comprehensive income. And I'm going to make the educated guess that these are going to be lumped into other assets. Why asset and not liability? Because this is operating. A lot of times operating items impact assets. I thought about maybe other comprehensive income, but this is an expense. I think about this akin to, a working capital line item. It's an add back to an expense. I could have linked it into liability. It's a little bit, I did some research on it. They're not really explaining what the expense is. And honestly, if we're to either increase an asset, increase other assets, or decrease other liabilities, it's not going to make much difference to your overall model anyway. So I'm going to link this into other assets so we can always change it. So I'm going to go right now, other assets equals to the year before. I'm going to go minus, because it's an asset, minus other operating expense, minus other expense. Okay, close, we're close. Okay. What else is left over here? What else is left over here? We got, foreign currency effect on cash equivalents. Now, this is always other comprehensive income. So, okay, and quick item here. When I said that there's three major categories that this could be lumped into, right? I said other operating expense, right, can be linked into assets, liabilities, or shareholders' equity. Accumulate other comprehensive income. A good clue into whether it is actually lumped into other comprehensive income is to see if it's a line item reflected here. Is it a foreign currency transaction adjustment? Is it an unrealized gain or loss? No, it wasn't. So I eliminated other comprehensive income. Now, foreign currency translation adjustments, foreign currency adjustments. This will be linked into other comprehensive income. Okay, so other comprehensive income equals the year before plus cash flow statement, foreign currency transaction adjustments. Okay. So we've pretty much captured everything. Deferred taxes. Now, deferred taxes, there's oftentimes here you're building up a liability, right? Usually a company will have a deferred tax line item. They don't. So I assume that their deferred taxes is building other long-term liabilities. Okay, so equals long-term liabilities from the year before plus deferred income taxes. Okay. Good. So we've basically captured every line item. And look, these numbers match, but I'm getting a no, which means there's some small rounding. Now, I will say, I've seen this scenario where you're off by a decimal and somebody says, oh, it's a rounding error. It's fine. You know what? It's not fine. It's got to match exactly. And what I believe is happening here, and I'll give you guys some techniques, but we're running out of time to know how I know, is I believe one of these percentages is accidentally being totaled and is throwing off our values. Let me check my totals here. No. Maybe this one. Ah, that 6% is being added in here. That 6% should not be added to our cash flow. It is a formula error. I think that's why our balance sheet's out of balance. So next class, I'm going to talk about balance sheet balancing techniques, but I'm going to sum up these columns in a different way. And that should fix that issue. Yes, now you're balancing. Now I could take this whole balance sheet, copy to the right, and I have a balancing balance sheet. I have a balancing model. How great is that? First shot. So I ran through that quickly. Please look at it, think it through. A lot more detail in my book. And I'm writing a new book on Amazon. But just for now, take a look at this, play with it. We did leave out, there are still some line items left hanging. Amortization of intangible assets. Some of these are left over from the template. Some are pretty important, like this line item. We'll tie up loose ends in the next class. We'll tie up loose ends, and we're going to dive into that debt schedule. That's the last schedule. Then we're done with the whole model. Then we're going to start valuing. All right. So I will see you guys next Monday. Take care. Thank you.